Just wanted to point out the information we provide today is of a general advice. If you do want some more information, please seek some professional advice.
Welcome to the Retirement Living Your Way podcast, where we have real conversations with Troy Theobald and the team from RFS Advice. My name is Greg Black, and it certainly is great to be here today. And today's topic is all around investment fundamentals. And I was going to throw to Troy, but we got Troy. You are in your happy place.
Oh, smiles.
You need a haircut.
Thanks.
But I've been meaning to say that for a while now, but you are in your happy place, aren't you?
This is a topic, and I'll spoil your thunder because I've got my right hand in the room today. So
you do.
There's the only person I know who loves this stuff as much as me.
Long time listener, first time podcaster with us. We have Josh Nixon. How are you, Josh?
I'm doing great. Thanks for having me.
Oh, mate, always a pleasure. Now, for those of you, Josh has been with the business for, coming up for 10 years.
Double digits, next few months, actually.
Which is fantastic. A shareholder of the business, an absolute powerhouse, both in the office and also out of the office. And Troy and often refer to Josh as our fitness coach because he does Ironman triathlons and all these 70-kilometre runs and that on the weekends. So certainly a very fit individual.
Coach, every time he says I should do more, I just say no, but I'm not sure about coach.
I feel better after talking to him.
Yeah.
But look, in all seriousness, today's conversation, we really want to have a look at not so much the portfolio construction. Okay, I actually want to dig down a little bit deeper or next level down and have a look at some of the underlying investments. And this really came about from one of our clients who does listen, actually wanting some more information around what are some of the underlying investments and what do they mean and things like that. So we'll break this into two parts because we haven't got enough time to do it.
I got excited.
And to be fair, I'm going to have to try and wheel you in a little bit anyway, just to sort of keep it within, even if we do split it into two. So I thought today let's have a look at more the conservative end of the market.
Yes.
And then the second one, Josh will get you back and we'll do the more aggressive, higher growth end of the market as well. So, but I just thought it'd be really interesting if we actually did a couple of, rapid fire questions.
Did you?
I did, and I just thought so. I don't really care who answers this, but I've just got some.
I can tell you don't.
No, I don't. So, and these are just things that I just want. The first thing that sort of, what do you think the right answer is on the spot? And I know every investment's got its place, and that's something that's really important, and it'll come through today's conversation. And there needs to be purpose behind each of the investments. But if I start off, term deposits, safe choice or inflation trap?
Safe choice.
Safe choice?
Yeah, I agree.
Cash, useful buffer or lazy money?
Useful buffer.
Absolutely.
There you go. Wow. Fixed income, still defensive or misunderstood?
Both.
I think both, yeah.
Did you guys like talking? Wow.
I'll
tell you what you got.
I'm waiting for controversy.
Okay. What about mortgage funds? Good income or hidden risk? Okay. You've just answered that one. Okay. Private mortgages, opportunity or too concentrated?
Is there something down from because that's getting even further.
Yep. Okay. What about balanced funds? Simple solution or vague label?
A bit of both.
I think this could be both as well.
Yep.
Yeah.
Okay.
Like the balanced fund, but you need a definition of what balanced is.
Absolutely.
Great point, and let's pick that up. Real return funds. This might be a bit, mightn't be familiar with some. Smart inflation tool or manager dependent?
Do love a good real return fund, so I'm going with smart inflation tool.
Yeah. Recent new versions, love them. Others from previous world and decades ago, couldn't run further from them.
Right. Interesting.
Yeah.
Well, let's pick that one up as well. And what about last but not least, and it's not really in the defensive category, but I've just thrown it in here because it's something that everyone understands. Yeah. Australian shares, income engine or too bank heavy?
I think we like the income Australian shares.
Yeah. Income engine tax credits, they're great.
There you go.
Everyone wants to talk about buying them for the up and down. I'd rather the income every year, thanks.
There you go. Interesting. Okay, well, we're going to have lots to talk about.
We will.
Okay, so let's really start off by sort of talking about why it's so important for retirees to understand some of these underlying investments.
Yeah, so I went do a bit of researching there.
Okay.
And it was interesting. I wanted to find out what are the biggest things people underestimate with risk out there. And the number one is capital loss. So some of those we've mentioned have the risk of permanent capital loss. And people need to understand that is a genuine risk in some of those structures.
Yes.
So they need to identify that. The second one's the behavioural risk. We'll ask them, how would you behave if markets moved? I'll be calm. Oh, I'm pretty sure. I used to say, Koshy on the telly won't give you a good thing. It'll be all scary in the morning and you're going to buy when he's saying the markets are down. We don't have him anymore.
No.
We haven't really got any morning person, I think, that jumps out with that quite as well. But they're still not going to be telling you the world's rosy and you should be investing when it's probably the very best day to do it. So how are you going to behave in regards to that? And are you going to change your risk behaviour and tolerance at the absolute worst time? Liquidity risk, when they go, it's only a small chance of a liquidity risk, that's normally the time you need the liquidity because there's a problem. So that's the time you need to make sure you know what that liquidity risk issue is. And the other one's that concentration risk. And, you have clients, they will come in and argue and know everything about that company. Great, I wouldn't trust any one company, any one share, any one manager with all of your life savings. We should be a diversified portfolio.
Yep. Anything else you'd like to add on that, Josh?
Yeah, I think Troy nailed it. I think separating the emotional side of it from the decision making, and that's why I suppose today part of is going through each of the asset classes, what they are, how they do, pros and cons, and then just trying to take some of those biases or emotions out of it.
Perfect, love it. Okay, so let's start term deposits. I think everyone understands them, but do you want to just sort of touch on where they can be used, some of the advantages, disadvantages, those sorts of things?
Yeah, sure. So I think term deposits, a lot of people are familiar. They've been to the bank. They understand it's known income, stable, and useful for short-term goals. Where people may get tripped up a little bit is if they decide or commit to a term, whether that's 3 months, 6 months, 1 year, and then circumstances change. So under that scenario, there might be break costs or just making sure you understand at what point in time you can access that capital.
And are you finding clients, a lot of the oldies, we've spoken previously about, the term deposits, and it's sometimes it is going and having a trip out, and they've got multiple
They might have
ones
with a number of different banks, pop in and talk to the people. What's the break going? What's your 3 month? What's your 6 month? They have that re-rolling from time to time. Banks tend to compete on that 6 month one. So if you've got a rule of, they all tend to advertise that out there. So you can split your money easily. If you're rolling a 6 month one, we sometimes say to clients, put 50% on 3 months, 50% on 6 months. And then in 3 months' time, when the 3 month matures, put it in for 6 months. And then you actually have something maturing every 3 months, and you're in that sweet spot of rates out there.
And sometimes you often, I'm aware that they'll set the best rate at a point so that when it comes up on maturity, it's usually when people are away. So all of a sudden people just automatically roll, and then all of a sudden that next rate drops a lot.
May not be as good. I
know.
Coincidence?
I'm sure it is. But No, exactly.
And particularly at the moment, it's having a look at a lot of the high interest savers out there on our website, which is
rfsadvice.com.
I just didn't want to get it wrong, so you had that over me. But it was about a month or two ago, I did the show on the radio, and that's on our website, free resource that's there. Went and researched all the banks' different high interest savers. They've all got little tricks, but they're paying a lot.
Yes.
So, you've either got to put a certain number of deposits in, some not allowed to take any out, some the balance has got to be higher. Make sure you know what their rules are.
Yes.
But a lot of instances, that's playing more than the term deposits now. So there's been a real change. But you've got to know their little tricks, and you've got to play by the rules. You miss it by a day, and you don't get that month's interest.
Spot on. Do you use them much, term deposits, with clients?
Absolutely. We like clients to have their own cash buffer.
Yeah.
So whether they hold it in cash, term deposit,
so
high interest saver.
You put that in that same sort of bucket.
From their perspective, we don't want them to lock it up, get excited in the bank. I got you a great 10 months. Yeah, that was there to fund the next 6 months though, so we can't have them locking it up. So that's the only thing to be wary of there. But, there's high interest savers now. The other reason why we like the high interest saver account, everyone's worried about fraud. Just have enough in your working account to, day-to-day things you want to spend. Have the next portion of your money that one step away. Just gives you that extra little bit of security out there.
Yep. Okay. And then, so just on that then, and you sort of mentioned before, like cash, what's the thinking around cash? When's it useful? When does it become lazy?
Yeah, and we'll have we use it as a buffer we like clients to have a couple of years buffer because we want to have their investments that can earn a bit more, be allowed to behave with markets. We reweight each quarter. We're buying when things are down, taking profit. We want to be able to do that. We can't do that if we've got to sell randomly at some time because someone's bought the van, they bought the four-wheel drive. That's a cheap shot at you, Paul, when you listen. On that, we want to be on the front foot so that they've got cash, they're ready to go in regards to that. So it's got to be there for that purpose.
Yeah, okay, and your thoughts on this, Josh? I know there's a bit of science, a bit of maths that's been behind it as well.
Yeah, absolutely. So there was a research paper done. If anyone was to retire in the last 100 years, you can pick the worst day possible, GFC, tech bubble, insert the catalyst there. If you had exactly 2.2 years worth of what you needed to fund your household, then if you separated the income and the growth, in theory, you wouldn't have to sell $1 worth of shares. Yeah. So what that means is a client can be comfortable that their day-to-day or their base needs are covered for a period of between 2 to 3 years, and that provides peace of mind because, yes, investments are going to go up and down, but if you try and separate the two, then I think that certainly helps a lot of retirees out there.
Yeah. Oh, fantastic.
So it's not being scared to hold that cash and term deposit, in our opinion.
Yep, no, great. And then moving up the curve a little bit, fixed income. Do you think that's understood?
Worst name of any investment on the planet.
It is, yeah.
Nothing's fixed.
No.
It's fixed if you had enough money to go and buy the actual government bond or issued by a large institution and hold it to term. So it's a fixed term for a fixed amount, the coupon.
Yep.
Very rarely is it used that way. Most people are in funds. And, there can be issues when we have interest rates increase or decreasing. We can have changes in capital value and people get very confused when that happens and they go, I thought it was fixed.
Yeah.
So you've got to look at the income component that you're going to receive, and then there will be a separate component because these are traded daily or by the minute, by the second. Bond market is some crazy amount larger than the share market. Absolutely. It is huge out there. So these institutions are out there, dealing in these constantly. So it's just knowing what you're investing in, and also what's the credit rating or risk. The higher the return, potentially lower the credit rating of the underlyings.
Yeah.
So just not the guided tour on that one. Wow, that one's earning more than this. Must be great. What's the credit rating? What's it investing in?
So when you're looking in this space then for clients, what are some of the things?
We want safety, security first. We don't. This is in our bucket. We don't want it going backwards.
Because I think that's one of the things I've observed. Too many try and pick up the return through this part of the portfolio. This is the defensive part.
We're not looking to increase return out of this part of the portfolio. We want good income, consistent, minimum vol.
And just to that point on considering we are talking about the defensive side of the portfolio, if you were to have a look at 2022, Troy touched on changing in interest rate cycle. That can often work against you. So when you feel as though you're making a safe investment decision, that could in turn actually see the capital decline over time. So there is an element of timing or understanding how interest rates do affect these investments as well.
Yeah. And look, and I should have said, Josh, and I apologise, you are also, besides a shareholder and an advisor of RFS, you are actually a member of the investment committee for our business as well, which Troy's the chairman. We've got 8 members on that committee, and obviously you're a key member of that, so people will probably sense that as you're going through things, you certainly do know what you're talking about. So
portfolio and spreadsheet tragic. Don't
start spreadsheets because Troy will get excited. So no, let's just let's park that. But I thought that was worth pointing out for our listeners. Okay, now we're starting to get into the area where I'm really looking forward to having this conversation because I know how this story goes. Mortgage funds.
Great while they work.
Yeah.
We don't have them on our APL, approved product list, for a reason, because I'll say I'm old and then you're older too.
Yep.
Well, you're not older than me, Dan.
Nearly.
Yeah. But from our perspective, we've seen and that loss of capital can happen. We've seen it on the coast here. We've seen it nationally. We've seen it happen. When you get major issues and major problems out there, that's when mortgages can fall over. So who's behind the mortgage? What security do you have behind the mortgage? Majority of clients, if you wanted to borrow money, you'd go out to the bank. The bank would lend you money. You could use the bank with your term deposit, all very vanilla, safe, secure. Yep. We're talking the next tier of risk and how far up those tier of risk. Is it something that is a rate that's a little bit more less paperwork lent to, or are we talking something the banks would run away from and this group will lend to, and it's your life savings they're lending?
Yeah.
So you need to be very careful. When these go wrong, they go wrong in a hurry. And a lot of people walk in our door and go, oh, I've got plenty of these because I'm boring, I'm safe, secure. I just want something that's really fixed and I've got an income.
Yeah.
And I'm like, you've come into an asset class that risks the whole capital value out there.
And the return you're getting isn't really taking into account that level of risk. Because if you've got that risk appetite,
correct,
you want to be compensated or rewarded.
Correct.
But you sort of, there's a bit of a misalignment here.
There's massive groups out there that do these and they'll say they've never had an issue, but my issue is that over decades I've met group that never had an issue until they had an issue, and they're no longer around. And it wasn't their savings, it's the client's life savings. So personally, just not a fan.
Yeah, okay. Any comments from your...
Yeah, and probably on that, we've seen a lot of the marketing, they'll have in large print a headline rate that does either get people clicking or interested, and it's really just about understanding what the product is under the hood. And one of the other points is around the loan to value ratio. So typically a bank will lend up to 80% of the value of the property. So it can be a little bit grey or unknown in certain circumstances that clients may be investing capital into some of these projects that have a different or varying loan to value ratio, which effectively means they may be taking on underlying investment risk that they're not aware of. So I think that's pretty important to call out.
Yeah.
So you're basically giving whoever it is the other side, you may or may not know your life savings to go into a project at their will.
Yeah, no, pass.
Not mine.
No.
Not an area that we get excited by. And private mortgage.
I was going to say, yeah, that's...
It's just the next levelling that up again. So that's almost one-on-one eyeballing the group out there, and it's fine. Some of them might be backed by, commercial property or property. You've still got to sell it. In my, years of looking, if somebody knows you're a seller and you're a forced seller, you're probably not getting the market value or price. So there's just all sorts of scenarios you just don't necessarily want to be caught up with in regards to that. And it was interesting when if we have a list on our website there, just what areas, because we broke it up into the advantages, disadvantages, risks, what market conditions suit and what market conditions are bad. We won't go through all of them because we don't have time. But falling property prices, borrower financial stress, rising interest rates, weaker development conditions and slower property sales.
And how are we going at the moment?
I'm ticking those off.
Tick, yeah.
So that, and mortgages similar there, falling property prices, tighter credit conditions, rising borrower stress, project delays. That's factually where these types of scenarios have headwinds.
Yeah, and certainly an area that we don't play in.
No, and that's it. And you just got to be careful, and red flags. And I even put in there what are signs of potential issues. And when you get them, it's probably too late, where borrowers' repayments are delayed, requests for extensions there, valuations start falling, and legal letters are coming in. And I go back to, to the GFC there where, we probably back in those days had portions of portfolios and mortgages and things because we hadn't seen those issues, and I did move all of our clients out of that. We had all of the, the BDMs and representatives coming out telling us, these arrears would be great, people will pay higher interest, and I've never ever seen when people not being able to pay their bills
You're going to pay more.
Working out well for anyone. So that just didn't make sense to me, and moving out of those structures.
Yep. No. Okay, moving along, what about balanced funds? And do you mind just sort of explaining what a balanced fund is? Because
I'd love to define it for you, but we don't have a definition in Australia for a balanced fund.
But
you would think we do. They're all over the telly.
We have a look at a lot of the industry funds. You look at a lot of funds, they'll say, our balanced fund did this or our balanced fund did that.
So that's a name. They can call it what they like.
Right.
But there isn't anything that says in our world, because we're in the advice world, so for us we will have a risk profile and we will have a guide. So for us, balance would be 65% growth assets, and we could probably wiggle 5% either side to stay in that to still be balanced. Yep. And we would have to explain to a client, we're still balanced, we're a little bit over, a little bit underweight, but that's what it is. If we suddenly had 80 or 90%, we'd have to go back and go, sorry, this is growth now, or this is high growth. So that's the issue is, there'll be funds out there that if we look under the bonnet are 90% in growth assets. There'll be others out there. Vanguard, look at their balance fund, really simple, 50-50.
Yeah, yep.
That's their version. They've just gone line in the
Yes.
sand. We're 50-50, 50% growth assets, 50% income. You know what they stand for.
Yep.
My issue with others is I don't know what they stand for. And when I go and look, and I did a paper for our clients there, then I looked at how they classified it. Now, some of them are even with their property going, half's income and half's growth. Now, I'm not sure the building here at 4CRB, which is the growth half and which is the income half, but it's still a building you've got to sell, and it's still going to move with the property market. So I don't know that you can just blindly do that personally, but that's a trend. And they're doing that to make their income component, or their growth, look lower, and the income component look higher. And I think that's gamifying, in my opinion, out there, because a growth asset should be a growth asset. It should be factual. If it's something that's going to go up and down in value, and it's going to be a growth asset. If it's something that doesn't move in value like a term deposit, it's income. It should be simple. So that's the issue we've got out there. You can't just look at the tally and go, oh, that's great, and look at our return and the next one, oh, they earn more than that, so it must be better. You look under the bonnet, which is what we do, and totally different. Then we get to liquidity and assets and listed assets. Now, I'll use Vanguards because they're on the telly. They're really simple. They use their ETFs, which are all listed. Really simple. They move. You see the value move every day. They're valued every day. You look at some of the other options out there for large industry-based ones, and they'll have a large amount of unlisted assets. Now, when are they valued? How often are they valued? Who values them?
Yeah.
And how fair is that valuation, and what are the cross-checks? Now, they're the things you want to know when you look under the bonnet, because you're talking about your life savings. So,
Yeah, wow.
and unfortunately, the structure was designed to try to bring a level playing field, but it's sort of had the opposite effect. It's now, these are all competing for everyone's money out there at the end of the day. But each of those different industry options, and it could be retail options, they're all competing for consumers' money. They're all putting ads on telly. They're sponsoring football teams and all sorts of that. So they're all, they've all got an interest in saying, look, isn't our stuff great?
Yeah.
How do we get our return to look better?
Yeah.
Better's not necessarily higher, and higher is not necessarily better. It's how did they do it?
Because, wow, you can really distort the returns based on the cycle, can't you?
And if someone wants a higher return and there is unlisted and higher growth, and they're happy with that, fill your boots. I don't have any issue at all with that.
Yeah.
But when they think they've got something they're comparing to, and this one's just much better, and
just a side question on that. If you've got, if you're sitting down with clients, and either of you jump in on here, sitting down with clients, how long would the conversation and what sort of tools would you be using with a client to determine what their risk profile would be? Because those that aren't getting advice, they're ultimately, they'd be ringing up and they're just having a 30-second chat, and they're picking A, B, or C, whether it's high growth, balanced, or light. What's our process?
So, thanks, Greg, for the question. On that one, so it comes down to majority of the clients that Troy and I look after are retired. So looking through a retiree's lens, that's why it's so important to identify how much risk they are actually applying for or taking on. Because if they're in a balanced fund that has closer to 90% in shares, they're agreeing to that structure, and then the outcome during periods of market uncertainty may be a long ways away from what they may have expected. So to come back to answer your question, we simply sit down, if the market dropped this, being whether it's the Australian market or the international market, how would you feel? What does that mean for you? In your world, how does that feel? What does that mean for you? What does that mean for your family and your longer term goals? So typically based on an initial meeting and the conversations that we have, we get a pretty good idea whether they're risk adverse or if they're looking for a higher return. And really it's just a conversation per client. But I would just say that majority of the retirees, it's their life savings. There's no more paychecks coming in. How do we balance stability and get the returns as smooth as possible whilst achieving their outcome?
Yeah, because we are spreadsheet nerds out there, and Josh, we've built this one at the moment, we can have a look at how much that we need to add into growth assets to get return 1.5% higher on average over a 2 to 3 year period, and it's not a huge amount.
Yes.
So you don't have to take on significant risk to get return up, if that's what they're after, and we can quarantine that into that growth bucket so it's there in regards to that. But balanced funds, it sort of feeds into the next one of that real return fund. And it's sort of the next evolution of those, just trying to smooth those up and down. Now, a lot of the time with these, you can give up some of the upside to smooth it down. And sometimes, investors out there, when things are good, can get a little impatient, forget about that and think they don't need it until they need it. And it's a bit late to add it back in. And then others of the real returns now have sort of focused on that, and they're probably earning more of the upside and still having that downside. So we've got, two that we use. We won't mention any individual products here today with those. No. But we always split an even allocation to those, and we know one of them is more defensive and will protect more on the downside. And we know the other one we use will potentially give that higher return on the upside.
Yep. And you could talk about that for hours.
Oh, we could show you what we're doing. How often do we reweight that, Josh?
Oh, gee.
Once a quarter.
Yeah, there you go. No, fantastic. And then last on our list was Australian shares, and I really should have prefaced it by saying, let's think of it from that income perspective. Okay.
Oh, they're all the same Aussie shares, aren't they?
Surely. So just on that, are they still a great source of income for retirees?
Yeah, so a couple of points on that. So if you're in retired and have a pension or a superannuation product, if you hold certain Australian shares, then at the end of that tax year, you are entitled to some franking credits, which on top of the standard income, which if you think is interest or dividends, you also get a tax refund. So I really enjoy pointing out to our retiree clients, I'm sure you've paid a lot of tax throughout your working life, but you do actually get an individual tax refund under those scenarios.
Only if you've got a fund that's doing that.
That's right.
So that's knowing where to look.
Explain a bit more.
So we call them an individually managed account in regards to that, or it's the client's own tax position per member account. So you want to go to your member account, and it should have a line item. If it's got tax out, it should show those refunds coming in. We can clearly see those and identify those with the platform providers that we have, and we wouldn't use a provider unless they could do that, because it's so important. It's a huge amount. Like, I think our core portfolio started $1 million a decade ago. It's worth well over $2 million, and I think it's $56,000 or $57,000 in franking credits, because we see that screen every day, because we like to explain clients. Well, we explain the downside to clients. If you can put up with the negatives, like our balance fund dropped 22% when the market dropped 55 odd in COVID and bounced back by October. We're explaining that to people. So people, how do you do that? We quarterly reweight. We have 4 different Australian international approaches. We equal weight those. We've got our philosophy. We can explain why. Australian shares, there's so many different options. There's really great smart beta options. Do you want to explain?
Yeah.
Sure. So effectively think of it in between an index and in between an active manager. So a smart beta can be used to have a rules or a quality overlay to the market, or in some instances as well, an equal weight. So that isn't a fund specific, that's just a certain theme or idea. So in that instance, instead of being linked to the index, which in Australia has high exposure to banks or resources, you simply spread the capital amount a little bit over each of them to try and reduce that risk and reduce that bias. And then one other idea around Australian shares that people may consider if you are a high income earner. So we've spoken a lot about retirees. If you are a high income earner, potentially some of those tax credits or imputation credits can help towards your end of year tax planning. It's still growing in an investment, but it's growing in an environment that actually benefits you, depending on that scenario there.
Yeah. Bit of lingo, we like SMAs to use that. You're going to go, what's that, Troy?
No.
Separately managed account. So that is the shares are owned beneficially in the client's name to get their own tax position, as Josh was pointing out, but professionally managed. And it really works well in that asset class.
Yep.
Because your own tax position is really important. Those franking credits, they're worth a lot of money.
Yeah. So how much time do you guys spend looking at this stuff?
Lots.
Lots.
And it's fascinating because obviously what we do as a business is very personalised. It's very much, it's in that, the strategic side and things like that. And we often sort of put the portfolio to the side. But I know the amount of work that you both put into this. And then we've also got external consultants that we engage just to, amplify that and things like that. But what would you spend on a Go on, put it.
I don't know if it'd be more. It's way more than I'd even guess, because we really do operate as that wealth advisor or sounding panel for a lot of family offices or large.
Because you go across all these. That's the bit on.
Because for them, they'll come in and we'll just pass an opinion as to what to look for, and that's why this was handy because we're. Is that mortgage great? No, but it's, well, what should you be looking for? What are the right questions to ask, and when would you get out, and how would you get out? And, you put it all with one provider and one company, and they're fantastic. Well, I wouldn't put it all with one share manager, so why would you put your whole life savings with one mortgage manager? So I'm just asking questions. They can do it, it's their money, but a lot of people can engage us for that type of scenario with that. And we do have clients wanting a higher return than those sort of model portfolios,
which we'll pick up on the next.
Which that's where we really love, getting into upside, downside capture and all those sorts of
exciting things. Yeah.
And not a surprise, I'm looking at my little timer there going, I got excited and ran over. Great.
Oh, yeah, fancy that. Who would have thought? Anyway, so can I just say thank you, gentlemen. As I said, this is the first part of the two-part series, so I think we might sort of call it there. Fascinating conversation just around, I guess, the underlying investments, and most of them have a place. Some in our world don't have a place, and that's just our personal view, and that's based on experience. That's the reality of it. But again, I think it's a matter of actually people understanding, okay, if you've got a portfolio, what is each part of that portfolio contributing?
What's its purpose?
What's its purpose? Risk, return, what is it trying to do? So thank you, Josh. Well done, mate. It's been great.
Pleasure to be here.
Oh, you did well. Very good. And Troy, go get a haircut, please.
I will.
Fantastic. Until next time, take care.